So in a previous video, we talked about how markets in theory can be perfect, but in practice rarely are. The real estate market is no exception to this. It is an imperfect market. So let's just go through some of the factors that make a market perfect and talk about how real estate markets uh, may or may not stack up to those particular criteria. So, number of buyers and sellers. In a perfect market, there are many participants, and no buyer or seller will have enough market share to control the particular market. Now, real estate is definitely not perfect in this sense. Though you may see in aggregate a large number of buyers and sellers that are transacting in real estate across the country, the markets you can say are actually really local. Okay, so the real estate market in Austin, Texas is not the same as the real estate market in Chicago, Illinois, is not the same as the real estate market in Oakland. And within each of these markets, you may have a limited group of sellers or buyers that are going to affect the market. So, for example, if you're trying to buy an apartment building in Berkeley, there are certain owners of apartments that maybe own a lot of the buildings in that particular market and are going to control kind of the setting of the prices. Okay. Or it could be that if you live in a small market, maybe there aren't that many buyers. And so for your particular house, or like if you own agricultural land in Winters, California, uh, likely the number of buyers who are interested are going to be your neighbors and other farmers around you, and there's not going to be that many of them. And maybe they're going to have some leverage over you, if especially if you're a forced seller and you like need to sell. The number of buyers may not be that great. So definitely real estate is imperfect in this way. Product knowledge and ease of exchange. So there's oftentimes asymmetric information in real estate markets. So for example, if you are somehow closely following the happenings in your city council, you may know that there's a rezoning or some change in the city plan that's going to affect a particular parcel of land for the maybe increase its value, and the seller of that, meaning the owner, may not be privy to that information. Okay, so there could be some extra research you've done, or maybe insider information, and you would have an informational advantage in that situation. Or it could be that the seller has more information. Maybe they know that there is some damage to the property that happened and they're not disclosing that, or that there's a nuisance. Maybe the neighbors are very disruptive and you're not going to know that by just looking at the listing, looking at the pictures online, or even visiting it once or twice. So there could be some informational asymmetry there. Exchange of real estate is also costly. There's a lot of frictional costs. There's legal, tax, administrative kind of things you have to do to transact real estate. So it's not that easy to exchange either. Standardized products. So in a perfect market, whatever products or goods are exchanged in that market are all the same. Real estate is the total opposite of this. Each parcel of real estate is unique. So even if you live in a subdivision where all the houses look the same, the locations are slightly different. The particular positioning of that house relative to everything else is different. Maybe it's in a cul-de-sac, maybe it's on a busier road. Every parcel of real estate is unique. So this criterion for perfect market is totally broken by real estate. It's the total opposite of that. Mobility, real estate is by definition immobile. You can't take a beachfront property and then move it to some other part of the country and sell it if you can get a better price. It's a total fixed asset. It's That's kind of how it derives its value. Oftentimes is by being in a particular location and place. So it's definitely not mobile. Size and frequency of purchases. Real estate trades relatively infrequently. Some families can own a property for many decades, and the property is not ever sold. So in that kind of from this perspective, real estate is not frequently transacted. the size of and the value of real estate assets vary tremendously. You can have some raw piece of land that doesn't really uh, have much use sell for thousand into the tens or 5,000 to $20,000, and then you can have properties that sell for many millions. Government intervention. So the government plays a very large role in the real estate market from various perspectives and levels. For example, just zoning and land use restrictions are they're within the scope of local governments. So a city or a county government may intervene in your use of the property heavily, and then all the way up to the federal level, there's kind of federal housing guidelines and policies and programs. The federal government heavily subsidizes mortgage financing, so they make mortgages much more available and cheaper. So there is a large amount of government intervention in the real estate market. Prices. So in a perfect market, the price discovery process is happening on a real time basis because there's so many transactions, and the market is able to incorporate new information and changes in supply and demand very quickly. Real estate is not like that because there are often very long delays in supply and demand kind of responding to each other. Um, when there's an increase in demand, uh, developers, builders may want to build housing very quickly to meet that demand, but there are a number of barriers to prevent that from happening. And just the construction process in general, even if they had the land and the approvals and everything right then, still takes some time. So the supply and demand dynamics are lagging each other in real estate. One just extra economic concept I wanted to introduce since we were talking about the government intervention in the real estate market, because the government will intervene also to prevent market crashes. Okay, so for example, during the COVID period, um, when unemployment was really high, the government stepped in and prevented banks from foreclosing. They prevented landlords from evicting tenants who weren't paying rent. So there's a massive government intervention to kind of prevent real estate assets from declining in value and the banks feeling the pain of that. Uh, this concept of moral hazard is basically when you have a entity that's going to bail you out. So if the government is kind of signaled and acted in ways to make you think that you are going to get bailed out even if things go wrong, you're going to take extra risk, more risk than you would have without knowing that someone's going to bail you out. So this is also present in insurance markets. So um, if you, for example, have insurance that will protect you from lost wages if you get hurt from whatever, taking some risk. Um, you may take the risk because if you get hurt, then you're still going to pay your bills. You're not going to really have a disruption in your income. And if you didn't have that backstop, maybe you would think twice about doing something risky, whatever it is. So insurance also suffers from this moral hazard problem where they are almost enabling someone to do something that's not in their best interest because that person knows that there is a backstop if things go wrong. Of course, the person will benefit from taking the risk and getting whatever benefits that accumulate from that without sharing it with the person backstopping them, which is kind of the problem. So it's like this moral hazard problem as a kind of asymmetric payoff. The person taking the risk gets to keep the benefits, and the person backstopping them is actually subject to more risk because that person is taking an extra amount of risk than they normally would have.